All right. Hi, everyone. We are CBSI Technology, and this is our earnings call presentation. I'm Isha. I'm the coordinator. Sabrina is the team leader. Jane is the product manager, and Ben is the scribe. And this is our analysis for year 10, but later on in the presentation, we're also going to make recommendations for year 11.
All right, so first off, we're going to look at our strategy for this year. So we keep a cost leadership strategy, which means that we keep a competitive advantage by being one of the lowest cost producers. And this also allows us to keep our prices down. And that is in the AC camera and drone market. And we also like to maintain a slight product differentiation. So looking into our goals and actual performance for year 10, our EPS growth was up 22% higher than or 22 cents higher than the target that we were going for. We had an ROE growth of about 7.6% from our goal of 35%. For our stock price gains, we were $16 above our target. Our credit rating was an A-, so we hit that target. And then our image rating was 11 higher than our target at 86.
All right, so here are some key reasons for performance. One is our EPS. So we calculated this by dividing our net income by stock outstanding, and it resulted in $5.77. And this was a 27 cents increase from our expectation. This is due to our highest sales and revenue to date, and therefore overall highest operating profit. Secondly is our ROE, which is net income divided by average shareholder equity, and that resulted in a 42.6%. And this was an increase of 7.6% from expectation. Also the highest net profit to date. And overall, this is a relatively high shareholder equity due to no stock repurchases and high retained earnings.
And then for our credit rating, we maintained an A-, and this is because we have a good debt to equity ratio of 32 to 68. So as you can see, we're able to, we have enough equity and assets to cover total liabilities. Our interest coverage ratio is 33.3, which really shows that we have enough profit to cover any interest expense we gain through loans. However, our current ratio is 1.38. It really shows that our current assets are very close to marrying our current liabilities, and this is because we have taken out a lot of loans to cover expansions and workstations to meet demand. So because we maintained a good debt to equity ratio and we maintained a good interest coverage ratio, that is why our credit rating was able to be maintained at an A-. As for image rating, what we have done to exceed expectations is really focus on having good corporate citizenship. As a matter of fact, we have won the Corporate Responsibility Award for years 9 and 10. We also have really high market share for cameras and drones. For cameras, we have a market share of 10.3, which is the second highest market share in the industry. And for drones, we are at a 9.6%, which is the third highest market share. So this increased our image rating by 11 points due to the high market share in both product markets. And we continue to make CSRC initiatives a priority for CBSI.
So looking at some more of our key reasons for performance, we had a great rise in revenues between year 9 and year 10. That was a rise of 12.4%, which was just found by subtracting year 10 revenue or year 9 revenue from year 10 revenue and then dividing it from year 9. We had a EPS growth of $1.77 per share. Our average return on investment was about 5.7% higher in year 10 than it was in year 9. We are still maintaining a good standing with the credit rating, and we had a dividend increase of 50 cents. And so to sum this all up, our stock price exceeded by $16 through continuous revenue, return on investment, earnings per share, and dividend growth. And we continued maintaining a good credit standing.
So now we move on to our expectations for year 11 and our plans for what to do. So for our earnings per share, it will be $7 for year 11. To get to $7, we will boost our net profit by cutting our costs in compensation and our costs in dividend payments. We will also repurchase shares of stock to lower our total amount of stock outstanding. For year 11 return on equity, which is going to be 40%, we are going to try to achieve this by lowering our gains on our ending equity by repurchasing more shares of stock. We also plan on boosting our net profit by also, again, cutting our compensation, by also raising product prices, and also by slightly increasing marketing. So as far as stock price, investors expect a $200 stock price. To achieve this, we are going to lower our compensation and our percentage profit given to charity to try to boost more revenue growth. We will repurchase more shares of stock to raise the price and to lower the amount of stock shares outstanding. For the credit rating, investors expect a rating of A. To get this, we will boost our current ratio by cutting our liabilities through cutting compensation. We will also start early repayment of loans to improve our interest coverage ratio and our current ratio. And to achieve an image rating of 91, we will continue with our CSRC initiatives, and we will also try to raise our PQ ratings by increasing product enhancements. And that sums it all up. Thank you very much.